Something unusual happened in the gold market this week. Not quietly, not gradually, but suddenly, violently, and with consequences few were prepared for. Prices didn't just move, they jerked, reversed, and shook confidence across Asia. Institutional money stepped back, retail money rushed in, and in between those two forces, the market began to fracture. This wasn't just about gold falling. It was about who was buying, who was selling, and what that says about liquidity, fear, and control in today's financial system. Behind the headlines, behind the price charts, there's a warning forming, quiet, structural, and dangerous. Because when everyday money starts driving a global safe haven, the risk is no longer hidden. And by the end of this video, you may see gold and markets very differently. Welcome to Boring Currency Index. If you've been around long enough to remember when money meant patience, discipline, and hard choices, then this channel is built for you. If you haven't already, consider subscribing, not for excitement, but to stay informed before the next shock arrives. And tell us in the comments, from which country are you watching today? The global gold market entered a sudden period of instability during what many traders first believed was a routine trading week. Prices that had been moving steadily began to swing sharply, confusing investors across multiple continents. Analysts noticed that the movement was not caused by supply shortages or mining disruptions. Instead, the shock came from a political and economic signal that spread quickly through global financial systems. The turning point began when Kevin Warsh was nominated as the next chair of the United States Federal Reserve. Many investors remembered his past reputation as a strong opponent of inflation. He had previously supported stricter monetary policies and higher interest rates. Because of this history, market participants assumed that he might resist aggressive interest rate cuts in the future. This expectation alone was enough to change how investors viewed safe haven assets like gold. Gold is often seen as protection against economic uncertainty and currency weakness. However, when investors believe interest rates will remain high, gold becomes less attractive. Higher interest rates usually strengthen the US dollar and increase returns from government bonds. As the dollar started to recover, gold prices immediately came under pressure. Institutional investors reacted quickly. Large funds and professional asset managers began selling their gold positions to reduce risk and lock in previous profits. The sell-off spread rapidly across Asian markets. Within hours, trading systems recorded heavy selling activity. Many analysts later explained that the speed of the decline revealed deeper structural weaknesses. Large financial institutions had been holding significant leverage positions in gold. And when prices started falling, automated trading systems forced these institutions to reduce their exposure even faster. This created a chain reaction that pushed prices lower than expected. Market observers also noticed early warning signs before the crash. Gold prices had been rising strongly for months, driven by growing global uncertainty and strong demand from Asia. Some experts had already warned that the market was becoming overheated. They believed too much speculative money had entered gold, especially from short-term investors seeking quick profits. However, these warnings received little attention while prices continued rising. For business leaders and investors, this event highlighted an important lesson. Financial markets often react not only to real policy changes, but also to expectations about future policy decisions. The nomination of a central bank leader does not directly change interest rates. Yet, it can reshape investor confidence and shift global capital flows. In this case, a single political announcement triggered a rapid market adjustment, revealing how fragile market stability can become when leverage and speculation dominate investor behavior. As institutional investors stepped back, a different force moved into the center of the gold market. This time, it was not banks or hedge funds, but millions of ordinary investors in China. Their actions did not calm the market. Instead, they quietly increased the pressure and made price movements more extreme. For many Chinese households, gold is not just an investment. It is seen as protection. Strict controls limit how much money can be converted into foreign currencies or sent overseas. Property markets have lost trust, and stock market gains remain uncertain. In this environment, gold has become one of the few assets that feels stable and accessible. When prices suddenly fell, many retail investors viewed the drop as an opportunity rather than a warning. Trading activity on the Shanghai Gold Exchange rose sharply as prices declined. Retail buyers rushed in, believing they were purchasing gold at a discount. Social media messages encouraged people to buy the dip, repeating a strategy that had worked during earlier price corrections. This collective behavior created a short-term rise in demand, but it also sent mixed signals to the market. While buying increased, confidence did not return. At the same time, speculative investors reacted differently. Some traders who had borrowed money to invest in gold faced immediate losses. As prices dropped further, they were forced to sell to meet margin requirements. This selling pressure clashed with retail buying, creating sharp swings in price and volume. The market became unstable, moving quickly in both directions within short time frames. Retail participation also changed the structure of demand. Instead of long-term investment flows, the market began to depend on emotional reactions and short-term decisions. Physical gold sales increased, especially jewelry purchases, ahead of the Lunar New Year. Shops reported crowded showrooms and long waiting times. Yet, this visible activity hid a deeper problem. Physical demand could not fully offset financial selling from leveraged positions. For analysts, this period revealed a critical risk. When retail investors become the main source of demand, markets can appear strong while becoming weaker underneath. Retail money often reacts to price movements rather than fundamentals. It enters quickly, but can exit just as fast when confidence breaks. In this case, the surge of household buying did not stabilize prices. It delayed adjustment and increased volatility. For business leaders, the lesson was clear. Market stability depends on the quality of demand, not just the quantity. When fear and expectation drive investment decisions, even traditional safe assets like gold can become unstable. What looked like confidence from the public was, in reality, another layer of risk forming beneath the surface. At first glance, the gold market appeared strong. Sales were rising, stores were crowded, and trading volumes were climbing. To many observers, these signs suggested resilience. However, beneath this visible activity, the structure of the market was quietly weakening. What looked like strength was, in reality, an illusion created by short-term behavior and seasonal demand. One major factor was timing. The Lunar New Year was approaching, a period when gold purchases traditionally increase across China. Families often buy gold jewelry as gifts or symbols of prosperity. This seasonal demand pushed physical sales higher just as prices fell. For casual observers, this created the impression that the market was absorbing the shock. In truth, this demand was temporary and driven by cultural habits rather than long-term confidence in price stability. At the same time, professional trading firms were reducing exposure. Quantitative hedge funds in China had already begun lowering their gold holdings ahead of the holiday. Their models were designed to reduce risk during periods of low liquidity. When prices started falling faster than expected, these systems accelerated selling. This created a sharp contrast between physical buying and financial selling. Leverage worsened the situation. Many investors, both institutional and individual, had used borrowed money to increase their gold positions during the earlier rally. When prices dropped, losses grew quickly. Margin calls forced investors to sell regardless of their long-term view. This type of selling does not reflect belief or a strategy. It is mechanical and unavoidable. As more positions were closed, liquidity thinned, and prices became more unstable. The visible activity in stores and exchanges masked this process. High volume did not mean healthy trading. It meant stress. Markets under pressure often show increased volume as participants rush to adjust positions. In this case, activity rose because investors were reacting, not because confidence was returning. The market was moving, but it was not stabilizing. For analysts, this episode demonstrated a common mistake. Demand is often confused with durability. Strong sales figures and crowded shops do not guarantee a solid foundation. When demand is driven by fear of missing out or short-term opportunity, it can disappear quickly. Once prices stop falling, buying slows. If prices fall again, fear replaces enthusiasm. For decision makers, the warning was clear. Market strength must be measured by balance and depth, not surface-level activity. When demand hides growing stress, the correction becomes more severe. The gold market during this period was not supported by stability, but by timing and emotion, two factors that rarely protect investors for long. The gold market has been on a wild ride, and it's not just investors who are noticing. Regulators in China are stepping in. Why? Because the recent price swings aren't just about supply and demand anymore. They're being driven by speculation, high leverage, and a whole lot of market emotion. With more everyday people investing in gold than ever before, this volatility is raising serious concerns about financial stability. In response, major state-owned banks are taking action. They're raising the minimum purchase amounts for gold and even putting temporary limits on trading. The goal isn't to stop people from investing, but to protect inexperienced buyers from making rash decisions and suffering big losses. It's a way to cool down the overheated market. Regulators are also getting vocal, warning everyone not to just chase high prices and assume they'll keep climbing forever. This is a big change in tone. Not long ago, the central bank's own gold purchases seemed like a green light for prices to go up. Now, authorities are hitting the brakes, trying to manage expectations and bring some calm back to the market. Thanks for watching, and don't forget to subscribe for more insights. This change exposed a deeper issue. When policy actions influence public behavior too strongly, markets can lose their connection to real value. Investors stop asking what an asset is worth and focus instead on what policymakers might do next. In such environments, prices become fragile. A small policy signal or rumor can trigger outsized reactions, as seen during this volatile week. For business leaders and entrepreneurs, the episode offered several strategic lessons. First, markets driven by retail enthusiasm require careful observation. High participation can increase liquidity, but it can also increase risk. Second, policy support does not guarantee price stability. When support is misunderstood, it can create bubbles rather than balance. Third, volatility in a traditional safe asset often signals stress elsewhere in the financial system. Gold's turbulence during this period was not an isolated event. It reflected broader pressure within global markets, where confidence is uneven and capital movement is constrained. For decision makers, the key lesson was not about gold itself, but about market structure. When liquidity depends on emotion and expectation, stability becomes temporary. In the end, the authorities' warnings served as a reminder. Markets cannot be guided by belief alone. Sustainable stability requires discipline, transparency, and realistic expectations. For those managing capital or building businesses, ignoring these signals can turn protection into exposure and caution into costly delay.